Welcome to our new video. In today's video, we are going to talk about stock market. We hear terms like share market, stock market, stock exchange, trading, etc. Can we explain what is a stock market?
Yeah, sure. See, before that, please understand this video is meant for viewers who are new to these terms like stock exchange, stock market, and all. Okay. So many people use these terms interchangeably. They are not very different, but they are not same. See, now, for example, share market is a market where it's a refers to the market where shares are traded. Whereas in case of stock exchange, stock market, um, all securities like shares, index, mutual funds, bonds, forex, derivatives are traded. Now, what is stock exchange? So, stock exchange is the place where public and traders operate, or the trading operations happen. The buying and selling of shares and securities happen. People come and buy and sell shares and other securities on a stock exchange. Now, stock market is a collection of stock exchanges, meaning it includes all the. Now, if you say Indian stock market, it includes all the stock exchanges operating in India. Now, another important term you must know is the market indexes. You might have heard of index names like Sensex, Nifty, Standard and Poor, Dow and Jones, and so on, right? So, Sensex and Nifty are Indian indexes. Sensex is of BSE, Bombay Stock Exchange. Nifty is of a national stock exchange, that's NSE. Now, how is this indexes created? Now, census is an index which represents multiple industries, multiple segments by having 30 shares in that index. Nifty has 50 such indexes in that index. Okay, so it represents multiple industries, multiple segments, and multiple diversified shares with different characters. Now, you might have also heard of index census going up, Nifty going down, and all. So what does that mean? So when we say an index going up, census or Nifty going up, it means it's a bullish market. When it goes down, it is a bearish market. So index actually measures the performance of the shares included in that index. Okay, which actually represents the whole market. It's supposed to represent the entire market. Okay, and it also shows you the mood of the market. And yeah, so that is what the four different terms you should know about stock market to start with.
Okay, can we see what is a stock market in a bit more details?
Yeah, so see, we see uh, how is a share listed in a stock exchange. Okay, so private companies cannot issue shares to the public to raise capital. They are not allowed because they are private companies. What do you mean by private companies? Private companies, you might have seen companies name with PVT or private before the limited, before the word limited in their names. They are private companies. The public companies won't have any private or PVT before the word limited. But I will not go into the definition of private companies and public companies because it's a different topic altogether. Now, private companies cannot issue shares to the public, as we said. So, if they have to issue shares to the public, they have to become public companies. So, public companies issue the shares to the public um, for the first time through a process called IPO, initial public offering, meaning it is the first offering of shares to the public. Okay. Now, once the shares are offered to the public and public subscribed or bought those shares, they are listed on the stock exchange where they are decided to list their shares. Now, this listing happens, subject to various rules and regulations of SEBI, Securities Exchange Board of India, which regulates the stock market operations. Now, once the shares are listed on the stock exchange, the stock exchange where the shares are listed, public can go and buy or sell those shares.
What are the primary and secondary markets?
Yeah, so as we said, the first time when a company issues or offers shares to the public, it is direct. It is direct to the public. So this is called primary market. Whereas once the shares are offered to the public, public have bought it or subscribed to those shares, they are listed on the stock exchange. Then the public and the traders can buy and sell those shares on the stock exchanges. They are called this is called the secondary market.
Okay. Who are market traders and the investors?
Yeah, so the traders are those who are professionals. They are professionals. So most of them are professionals. So they buy and sell shares on stock exchanges. So what do they do? Normally they buy shares at a price and sell it at a higher price to make profits. Some traders do sell first sell the shares and then buy those shares at a lower price to make profit. So this is called the short selling. This particular way of doing, buying first, selling first and buying later is called short selling. Now, when traders complete both the operation, meaning buying and selling or selling and buying on the same day, it is called day trading or intraday trading. It happens, both the operations would be completed on the same day. Now coming to the investors don't come to trades. They buy shares and hold it for a long time, for months or years, and they will sell these shares or the securities when they need cash or when they feel that the prices of their securities have gone up, so they can sell it and make profit or book profit.
Is trading and investing a good investment option?
See, this depends on many things. Now, trading needs a lot of skills and experience. Traders need to have very good understanding of the market, very good understanding of the economy, very good understanding of the company's financials. They are the shares of shares where they are going to trade on. So they should have a very good understanding of this the entire stock market economy and all. So the newcomers, the people who are new to the stock market, we suggest, should not get into trading straight away. So first they should try to understand the market, the dynamics of the market, before venturing into that. Otherwise, it can be risky. Now, for the people, who are new to the stock market but they want to start investing, the best option is mutual funds. It gives you an opportunity to invest in shares indirectly, not directly, without much of a risk and without needing a lot of experience and skills, because these mutual funds are managed by professional fund managers. Okay, now we have we have published a video on mutual funds earlier. You can go and watch those videos, which will give you an idea of what is mutual fund, how does it function, how to invest, when to invest, and also things. Now, coming to investment, people who are investors don't trade, actually, as we said earlier. So they buy shares and hold it for a longer period, a long time, like 3 to 4 years of time, and and then they encash it, or they liquidate those securities, when the correct time arises. Multiple can be multiple reasons, but one thing we must understand about the stock market is, if you see the Sensex over a long period of years, say 5 years or 10 years, you will see that the index only goes up. It never, it's very rarely it comes down. It always goes up, over a long period. Though there can be ups and downs in between, meaning in a shorter period, in days and months, it may go up and down. But if you plot a line, it will only be going up, which means the investors who hold their investment in shares or other securities for a longer period would probably not lose money. They would only make money. But be careful about one thing. See, there is a saying that don't put all your eggs in one basket. So now, suppose you invest in one particular shares or an instrument security, there can be a chance that that security, that share may not do well in the long term also. So what is important is you should have a portfolio, meaning you should diversify your investments. You should put in multiple securities like shares, mutual funds, and different other forex and so on, and even within the shares, in multiple industries and so on. And that then what happens, even if one share, one security uh, does badly in the market, some other securities will actually compensate for it. It will go up. So overall, the diversified portfolio will help you, managing that risk actually. So, but if it is one, there is always a risk. But anyway, we'll come back with another video on this portfolio and diversification later, because that's let's see how people make money on this investment or trading. Trading, we are seeing, now you buy and sell at a higher price, or you sell first and buy at a lower price to make profit. Okay. Now, investors make money in two different ways. If it is shares, if it is bonds or this thing, the return will be in form of interest. In the case of shares, there are two different ways of income. One is the dividend. Dividend is the amount of a portion of profit distributed by the companies to the shareholders. So that is a dividend. So you get dividend when it is declared. So dividends are normally declared at the end of the year, after the closing of the books, or there can be interim dividend in between too. But the major way, the most important gain is by appreciation of the securities you hold for some. Meaning, the appreciation gives you capital gains. So that is how you make money. Very important. Now,
I think we will need more videos on this subject, as we can't cover up this topic one or two videos.
yeah, so there are a lot of things, a lot of instruments, a lot of methods, a lot of rules, and then, how to operate demat account, trading account to, invest or trade in the exchange, and how to mitigate the risk, understand the risk, the tax implication of your investments, as we said, diversification, portfolio, and so on. So we will come back with a few more videos on these topics later. Till then, bye.
Bye.
Please
Subscribe,
subscribe our video if you are new to this our
like and
channel.
share it also.
Yeah, and watch it from fully.
Thank you.
Thank you.